everyone, this is Real Life and Realty, again with two people. You don't have my head in front of the tree. This is being pre-recorded, so it will come to you live on Tuesday at 11:30, but we are pre-recording that, so therefore...
Too bad we don't have the lottery numbers.
I know, that would be really awesome.
That would be rad.
Now I could win millions.
Me too.
So if you have questions, leave them in your comment, but we won't be able to answer it in this film, but we will definitely get back to you with all the questions and comments.
Absolutely.
So this is Jerry. He
Hello.
is my favorite lender guru. He helps me on absolutely everything.
I'm always available.
He is always available, and I'm not easy with my lenders. God knows. So if he can put up with me, then he's got it.
Yes.
So today we're going to be talking about home style and 203K loans, which are pretty much rehab loans or fixer-upper loans. So why don't you tell us a little bit?
If you're looking at the market and you keep looking at houses and you can't find anything because you're always outbid or you're asked to do an appraisal contingency, which, you know, Kelly's really good at counteracting that negotiation. So definitely a great agent to have on your side. If you have those and you're just getting totally frustrated with the whole process, there's loans out there that can help you get into a home. You might get the home that's the ugly duckling on the block, and there's different, you know, programs for different people. Everybody's different, so I'm not going to try to get into all the details of each program because it's just going to confuse everybody.
But like I was saying earlier, location is everything. So if
Absolutely.
you want to be in a certain neighborhood and there's a house that maybe isn't to your liking because
and you pull up to it and you're like, no, I'm not even going in there. You go in there and the kitchen's just like from 1950, which that's what I bought. I bought a house 1955, never been upgraded. I gutted it, fixed everything up. Now it's the best house on the block. Everybody's just praising me, and you know, I've made a ton of equity, and that's the way you do real estate. Is you want to be, you don't want to buy at the top and then you can only go down.
Well, and the other thing this helps for is a lot of people don't have $50,000, $20,000 sitting in a savings account.
Exactly.
They're already putting enough money as a down payment and closing costs. Who has money to do the repairs and remodels? The other thing to think about too is when you buy a house and it's already turnkey ready, it might not be the kitchen you want, or it might not be the bathroom you want. You get to
flooring,
custom this.
the paint, the appliances. And with the conventional versions, you can actually add a pool. If you don't have a pool, you can add an addition. So say the house is not as big as you like, it's in a nice area and it's got a big lot, you can do an addition as long as it's attached. There's a lot of different things you could do. Now you say, wow, that's going to be expensive. But if you can, if those houses primarily are on the market for a long time, so they have the seller's a little bit more motivated to sell the property. And what this does is it helps you get that leg up and have that. Where like a primary residence, you're only putting in a FHA, you're putting 3.5% down. That's the only money you have to do, and you can still do the upgrades, and you're buying a house for a lot less. It's just it's basically money in the bank. You're using an escrow holdback after closing the deal to actually pay your contractor, which we can get into the contract.
But you also get to move in right away, correct?
You get to, well, you can move in right away, or you can actually even, in some of the programs, you can actually put into the loan where you have 6 months of payments that are actually paid for. So say you're still, you know, renting a house and you're buying a house, or you're living with family, or whatever your situations. There's so many out there. You can actually have the payment draws come out each month to pay the payment for 6 months.
That's awesome.
So you can actually just go in and completely redo the whole entire house, which is amazing. And you only have to put like 5% down. That's the only money out of pocket. So you take these houses that have been on the market for a long time, it gives you a leg up, and it gives it more of a buyer's market versus a seller's market.
So how long do they have to get the work done?
You have up to 6 months to get the work done. In some programs, it's a little tighter in different situations. There's always going to be something different for each and every person, so I don't want to get into details there. Well, it's more of a case-by-case
and I heard too,
basis.
If they have a favorite general contractor, their contractor just has to go through your company and get approved.
So
they can
they
use
can't have anything
contractor
against them. They have to be a contractor that's completely on the up and up, doesn't have any negative remarks or negative, you know, feedback or negative business bureaus, and they have their own insurance, and they're covered, which you want anyways. If you're going to do a remodel on your house, you want it done where it's got a warranty and it's going to be supported by somebody that knows what they're doing.
Now, correct me if I'm wrong, but what I also heard is you need that contractor to give you the opening bid. So if you go in there and you say, I want granite countertops and I want this and this and this, and the contractor says $30,000 for everything, and then when you buy it, you decide, oh, I'm going to paint this myself. You can go ahead and paint it yourself. And say you take a loan out for $30,000 and you don't use all 30 of it, what happens to the remaining balance?
That'll be on the escrow holdback, and you can either, utilize that for different upgrades, which there is change of circumstances, which you might have like something that comes up while you're in the process that you can't see because you can't, you don't have bionic eyes and
what? I thought people could see behind the walls.
See behind the walls. So there's always like a 10% like fallback where you can actually utilize that to, do other things as well.
But if they wanted to, they can lower the loan amount back down.
Yeah, basically the scope of work and where it comes from is what you want to do. You ultimately wanted to change the carpet, change the flooring, change the appliances, change the countertops, change the kitchen, do a bathroom, whatever you want to do. Paint the walls, do the crown molding, do the, whatever you want to do. Everybody's different. You do that, you get a scope of work. Now that scope of work is going to go into the appraiser's hands before the appraiser actually does the property. So he is now going to look at the property through different eyes. Like, okay, now it's got a new kitchen, it's got this, it's going to be worth more money, yada, yada, yada.
Awesome. And then I was also told that, basically you're financing it. So if you buy a home for $500,000 and you decide you want to do $50,000 worth of work, your loan amount is based at the $550,000 and your payment and everything. You just need to qualify.
Exactly.
Okay.
So it depends on your DTI, which is your debt to income ratio.
And is there a minimum credit score for this?
There is not. There's different programs for everybody. So I guess the minimum credit score would be FHA minimums, and that's 580 FICO score. There's also 620 when you get into the conventional version. They like to stay above 620. It's conventional, so it's a little bit, more strict on that end. And then just so everybody knows about debt to income ratio, that's basically your income, your gross income minus any debts you have. And debts aren't, groceries and so on and so forth. It's going to be your debt to income ratio, which, did you go over this?
Yeah, it's actually episode number 1. So if you want a complete breakdown of debt to income ratio and what qualifies for in your debt to income ratio, by all means go back to the Facebook Real Life and Realty in episode 1 and you will see it there.
And the brilliance of this is, say that the seller, wants the property sold and you do this type of loan, it still closes within the 30 days or whatever process it's going to be. The seller gets his money or her money. They then move on with their life. And then the additional money for the upgrades is going to be put into an escrow holdback account, and the escrow company will be in charge of distribution of the money to the contractor.
So is that any normal escrow, or does it have to be a special escrow?
It could be just basically any escrow company that you're happy with. I don't choose escrow companies.
And can you? I'm looking at your notes, so I kind of already know the question, but I'm asking so the rest of you guys know. So can you do this on investment property? Does it have to be a primary residence?
There are programs for investment properties. There's programs for 3 and 4 unit properties. There's where if you have like a duplex, you can do duplexes. There's a little bit difference in the LTV, which is the loan to value, the requirements, but we can get into detail there if people are interested. Like you see a house where you can make it into a duplex. There's possibilities of doing that as well. So there's so many different things that's out here that we can help you with.
Well, and I'm guessing too, the lender is going to require everything needs to be permitted and
yes,
done
it's going to
properly.
be a longer process, especially the upfront part of everything. So if you're interested in this, let's talk. Let's just give me a call. You can get the number. It'll be at the bottom here. We'll talk about it. We'll hash it out. Everybody's different, so I can't say one thing is gonna meet everybody's expectations or requirements. So let's meet. Let's figure out exactly what you're looking for, and Kelly can help you on the real estate side. She has tons of listings that are out there that people just aren't looking at because they get there and they're like.
Well, and here's the main thing too. You go to these houses and they're flip homes, and the investor came and they flipped it and they're making lots of money on that, but sometimes they're not necessarily doing the best quality, or sometimes they're not necessarily doing the best things. So you get to kind of, instead of having it be a flip home, you get to do it kind of the way you want to do it. So if you're out looking for property and you find these perfectly modeled homes, those model homes, they're going to ask you high price for the house. You're going
They've
to
already
get
done all the stuff.
Yeah, they want
that
top dollar.
That you could do yourself and make it your own home. You could
Yeah.
choose your own carpet. You could choose your own flooring. You could choose your own appliances. You could choose your own bathroom, your own bathtub. I mean, it's a great program, and it gives you a leg up and gives you more power when you're buying. I know it might be a little bit longer, but do you want the house of your dreams, or do you want the payment that you don't want to afford?
And I know a lot of you, or some of you that are my clients, have heard of the 203K loans. So what's the difference between home style and 203K?
203K is going to be your FHA version.
Okay.
So it's going to be a little more strenuous. You're going to have the government kind of underwriters checking everything and double checking everything.
But it's still basically the same interest rate and the same loan to value at 97%.
It's the same. It's the same loan as if you were to just buy a house that was ready to open from an FHA standpoint. So you have the same interest rate, you have the same loan, you have the same everything. You just don't have the additional money put into escrow for upgrades.
And then with conventional too, can they do $1 million home, or they have to fall in within?
You have to stay
limits?
under jumbo limits, and those are going to be different in all different counties. You got Riverside County, you got LA County, you got Orange County.
An average for LA and Orange is what, about 625?
625. We're at 627, 625.
So I mean, if you basically, what we're saying is, if you find a house for 500, you can use all the way up to your county loan limit. So if your county loan limit is 625, that's $125,000 you can do of repairs, remodeling.
Think about that. $125,000 of upgrades.
Yeah,
now tell me that house isn't going to be worth a lot more money when you're done with it. That's why flippers make so much money.
Oh, absolutely. And you always want to be the worst house in the neighborhood and not the best house in the neighborhood. Now, granted, for people who are being investors, this is an investment loan, but for most people who are going to live there a long time, they want a really good bang for their buck, and they want to get into a house and make it as nice as, the really nice model home down the street. And this is the perfect way to do it, because you get to create it your want. Now, of course, the only thing that this wouldn't work for is if you have to be in a house right away,
right.
Aunt
and
Sally kicks you out.
We have programs for that too. I could close in, 16 days. I could close whenever you need to close. I could do, VA. I could do jumbo loans. We have all types of different loans. There's a loan there for everybody. I guarantee it. And if you're not, I have a credit service department that will handle you to get your ducks in a row to help you get into a home of your dreams.
Yeah, actually, I wanted to talk about that. So I have a credit person that I've been waiting to come on. And fortunately, he's kind of hard to get a hold of. So not when you have him working for you, but right now to be face to face, he's kind of hard to get into. So I was talking to Jerry about that, and he's like, we have a whole department on credit. So I've asked this question multiple times before. If credit was not an issue, what is holding you back from purchasing? So right now, you can put as little down as 5% for conventional, 3.5% down for FHA. And if you feel like your credit...
There's even 100% financing.
Yeah. Well...
It's like VA for the person that's not a veteran. There is programs out there like that for people, and it goes as low as 580 FICO score.
Well, and if you feel like your credit's not good enough... You can even
use a roommate's income. It is completely just crazy, and we can get into more detail if you're interested in that kind of stuff. If you're interested and you're kind of like, I'm afraid to check my credit. It's like I don't want to.
Now, here's the one thing I want to put out there.
Let's get your ducks in a row. I don't judge people. I don't. We're not going to judge you. It's all about you getting into a home. If you're renting, you're throwing your money away. Just do this.
True, but I want to clear up this too.
How long have you rented? Now add each month that you've rented and how much you paid, and do that for 5 years.
Probably about $25,000 a year.
A lot more than that.
A year, though.
Right.
Give or take.
It's just money going away.
But the other thing I hear of people saying is, I don't want my credit to be ran because it's going to hurt my score. It's not going to hurt your score.
I could do a soft pull credit score.
Yeah, but they don't know what soft pull is.
Okay, soft.
So basically, Fannie Mae passed a law probably in about 2012. So it's been a long time, people. And Fannie Mae said that every single person who is applying for a house isn't necessarily buying a house. So if a mortgage company, and it has to be a legitimate mortgage company, runs your credit, it does not affect your score. Now, granted, if you go and buy a car and you go to Toyota and then you go to Honda and then you go to Mercury, and by the time you go to Dodge, your credit score is 20 points down. Well, it's not the case with mortgage.
No. And with cars, it's the same thing. It kind of piggybacks off cars. If you run your car, like if you go to a car dealership, they're going to run your credit like 60 times. It's within a 45-day period, your credit score is going to stay the same. So if you run it's actually smarter to shop than it is not to shop. Just like if you go to the first car place and you buy the first car, you're really not doing yourself any due diligence. So it's a 45-day period. It counts as one inquiry for all of them. Now, if you're going to JCPenney's and you're going to Victoria's Secret and you're going over to, Best Buy and you're looking at the Best Buy stuff and you buy a TV and then you go and you get, furniture and you go, that's where you get jacked up on your credit.
Yeah, I think it's like 3 points every time it gets run down. So worst case scenario, I have a lot of buyers that I've worked with well over 6 months, even going into a year. So if you're a little bit hesitant, figure it out now. Start getting on the automatic email search.
But even with that, I can still do a soft pull,
True.
Which is a soft pull. It's not going to count against, you don't see it in anything. It's like going on to Credit Karma.
But the main thing is, I think with buying a house is there is nothing better than an educated buyer. So Absolutely. If you know what your credit score looks like, if you know what your debt to income ratio is, if you're prepared, also if you're on the automatic email search and you know that the houses in this particular neighborhood are going for this price, then when it comes time to buy, you're prepared, opposed to all of a sudden you want to buy and you don't know what your score is.
And then you're backtracking. Oh, where do I come up with the earnest deposit check? Oh, where I gotta pay the down payment. Oh, I gotta pay closing costs. You're not prepared. That's what we are here for. She's really good at doing her part. I'm really good at doing my part, making sure you're comfortable in a payment that you're comfortable with and finding the best program for you and your family.
Well, I'm definitely going to have your phone number at the bottom, but why don't you go ahead and say now and tell them your company too.
I'm with AmeriFirst Financial. I live in Whittier. I work in Southern California. I do loans.
And he answers his phone all the time because I call.
I will commit to you to be available anytime you need me.
Tell them your phone number.
My phone number is 949-357-9185.
And then also too, for any business owners, we have our Real Life and Realty magazines. It has all the top homes for sale that are surrounding your particular business. So
go get your hair did.
Yes, absolutely. So any type of business owners, if you have a magazine rack and you would like to get a magazine once a month of all the homes, completely free of all the homes in the area, by all means, let me know. Put a comment in the comment area. And if you have any questions, just either call us, text us, or leave a comment.
Any questions? There is no dumb questions when you're making a huge investment.
I think you want them to ask you questions.
I love questions. Questions are the best.
Yes. Well, we're Real Life and Realty, and we will see you next Tuesday. Bye.
Over and out.